Ted, you and I were talking about food delivery services and how big it's become because of the pandemic. I was reading the Financial Times last week, and it said that Deliveroo, which is a very large company in the UK, is considering an IPO, and they're pushing for a valuation of £7 billion, which is about $8.5 billion. And that got me thinking, that seems really high given the total market valuation is about 8.5 to $9 billion for the total market. And you mentioned DoorDash as well in the US. So you came up with a great idea that we should probably do a session about the both of them. What did you find out about those companies?
Well, absolutely. So good to see you again, Moeed. Interesting enough, I'm not a big user of Deliveroo and Uber Eats and all these delivery companies, but my kids, I've got 5 kids, and they are all obsessed with it. So I was very excited. Just the other weekend, I actually had my first Deliveroo order, and it was my 19-year-old son who actually delivered it. So he is actually one of the gig workers working for Deliveroo on his bicycle here in Southwest London.
Right.
So you're absolutely right. I wanted to have a look at the financials behind the company again, just get a feel for what's going on. So here we go. I'm just going to share the screen with you. So let's have a look at Deliveroo's financials first of all. So here they are. So Deliveroo actually is a brand name. The company Deliveroo doesn't exist. It's trading as Roof Foods Limited, or Roo Foods, sorry, Roo Foods Limited. So if you're looking for the company, don't look for Deliveroo, look for Roo Foods Limited. Here they are. The latest set of accounts for 2019. They'll be busy putting together their accounts for 2020, but we're not going to get those for a few more months. And what do we see? Well, it's making a loss. 2018, it made a loss of £232 million. And in 2019, they made a loss, bottom line, of £317 million. So I'll just put my little annotation on. So there's the loss for 2019. There's the loss for 2018. The loss is getting bigger. The loss is getting bigger because they are effectively selling more. So you can start to see here that they're growing their business, which is good, but unfortunately the loss is going up. Interestingly enough, the gross margin, so if we actually compare the gross profit figures here, they're actually going from a 19% gross margin in 2018 to a 24 gross margin. So what that means is that at least the cost of doing the business is profitable. It's not like they're buying a can of Coke for for £1 and selling it for 50p. They're buying a can of Coke for £1 and selling it for £1.25 type of thing. So that's a kind of an idea. So at least underlying, they are making they're trading at a profit, which is very, very important at this line here. And then we see the admin expenses here is a significant increase. Now, these should be our fixed costs. So as the business is growing, you'd expect the fixed cost to grow a little bit, but this looks like a lot of investment going on. This is a race to the finish for this company. It's kind of who can scale quicker.
Makes sense.
We might want to compare that to DoorDash. You mentioned DoorDash, which we've been looking at as well. So here's the equivalent numbers of DoorDash. Just pull them into the middle of the screen here. So the top line is the revenue. This is in millions of dollars, you'll notice. Again, they are 2018, nearly 300 billion of turnover, up to 291 million. My mistake, sorry. So 291 million, 885. So touching, and they just got over $1 billion. So they're now 2 billion, 9 months ended 2020, and they're on forecast to try and get to about 2.5 billion by the end of the year. Here's their cost of sales. They're actually operating at a 54% gross margin. So much higher than Deliveroo. Wow. So that's basically saying that, they're buying a can of Coke for £1 and selling it to the end punter for £2. That sounds quite a lot to me. You know, am I really going to, who's taking the hit on that? Am I buying it? You know, is the restaurant, is the delivery restaurant actually taking the hit on that, or is it the actual the customer who's paying more for that delivery? So, you know, that cost has got to go somewhere. Still, the cost of running the business, that's all of these bits here, are very high, which means it's making a loss. So we've got two companies here which are making an operating loss. Now, Deliveroo making a 41% operating loss, so quite a big loss. These guys, slightly lower operating loss, although it was at 70% back in 2019. Deliveroo 41% loss in 2019. DoorDash are starting to sort of bring that down, and they are forecasting, you know, they should, if they get those costs under control, they should be able to break even at least by the end of 2020, hopefully.
Very interesting.
So what is it? So let's have a look at the always like to look at the strength of the company sitting behind this. So we've looked at the kind of the trading account. These are companies which they're basically loss making. You kind of expect that if you're going to start a company, a very new company, often it's going to make a loss in the first few years. We've looked at Kazoo, for example, making big losses. And I liken that to a bit like the space shuttle, for example. So they're burning lots of cash. They're trying to get the kind of the brand out there. They're trying to get market share so that they ultimately win. Kazoo is the only one really sitting in that space. So they're kind of, you know, they're in a unique part of the, you know, there's no one really sort of or doing what they do. Whereas DoorDash and Deliveroo and Uber Eats and all those, you know, other equivalent companies, there's lots and lots of them out there. So there's a big rush from all of these companies, and not all of them are going to win. So the question is, who's going to survive? Who's going to win? Who's got the strongest offering? And also your point about, you know, the actual market size itself, you know, if somebody captures that market, do they get to keep that market? How easy is it for other people to nibble away at the edges, for example? You know, how easy it's for I to kind of say, I'm not going to use Uber Eats, I'm going to use Deliveroo, or vice versa, for example. Here's the balance sheet of Deliveroo. And we notice for the balance sheet, so you know, if you think about it, this company, there's not a lot of fixed assets on there. So the non-current assets relatively low, 130 million pounds, whereas it's all about their current assets, their working capital. So that's, we're looking at this number here, which is 305 million pounds, and most of that is cash. Little bit of trade receivables, which will probably just be, you know, money sort of in the system, so to speak. They don't hold any inventory, as you'd expect. That'll be, you know, probably a kit for the workers. So it's really a cash basis, and the idea is that, do they have enough cash so that they don't run out as they grow this business? One thing you might notice, Moeed, is that the net assets have gone from positive 185 million to negative 31 million. Okay, now that should start to ring alarm bells at us, but it's not actually a big issue, because you'll notice this line here, this other liabilities, is effectively debt financing. Okay, so this is debt financing the business. Now, I'll just bring you onto looking at that debt financing, and what it actually what's going on there, so that we're clear, and why it's not an issue.
Yeah, because you found something interesting there. So yeah, just looking forward to that.
So what you can see on your screen right now, Moeed, is the other liabilities. That's the notes to the account. And you'll notice this short-term finance is 200 million, and the short-term finance is a convertible debt at the option of either party. Okay, so in effect, it's about a little bit like you set up a business, I lend you 200 million pounds, and either I or you have the option to convert it into equity. So if your business is going to do really well, obviously I'm going to convert it into equity so I can share in that. If your business is doing really badly, then you may choose to get me to convert into, so that you have a little bit more and you don't have to give the money back. But if the company just kind of teeters along and kind of doesn't do well, it just survives, and I just think I don't want to expend any more energy in it, then I can pull it out. So really, I would see that as a kind of, I would call that equity funding. I would take it out of the non-current liabilities and I would put it into the equity part of the balance sheet. So that's 200 million. And if we put that into our balance sheet, what we would do is we'll put it in here. So we would actually take the money out of here and stick it in here. And in effect, it says that they've got a positive balance sheet of about 170 million, which is really equity funded. So it's kind of, it's equity, but it's pretending to be debt in the way it's presented.
So, and that's interesting because in a growth market, that's not uncommon, right? Because you can actually provide concessions to those who are lending you that money and saying, our business is going to, the market's growing. And I think food delivery in the UK, which is where Deliveroo is playing in, that's projected to grow at 5.6% compound annual growth, which is quite high, actually. The average industry outside of tech is no more than maybe 1% or 2%. So they probably make, and it's not uncommon for this, right, Ted? Because you would probably go to a lender and say, look, our valuation is going to skyrocket. So, you give us a good deal on that lending, on the lending of the money. And, you can have an option of, making big bucks if you convert it to equity when we're doing well.
Well, I think actually you're coming at it slightly the wrong way. So rather than thinking about this is them going to a lender and saying you can share in the success, they're actually going to an equity investor and saying you can structure your equity investment as debt, which just de-risks it very slightly.
Ah, right.
Okay, so that's really, so this is an equity investor who's just put it in as debt, but don't forget, at any time they can just convert it straight into equity, and the company can convert it into equity. Okay, so
right. No, yeah. When I said lender, I actually meant investor. Sorry, yeah. I used the wrong terminology. Yeah,
exactly. So this is an equity investor who's just chosen to structure it as debt. So this is very much looking at structured finance and a way of actually putting that investment in. And it just means that, if things aren't going well, it's a very easy way to get your money out and walk away and say, I don't want to play anymore.
Interesting.
So let's have a look at the balance sheet of DoorDash. Here it is. And you'll notice, first of all, if we just look down the bottom, so the important numbers here, you can see this is the amount that's been invested by the shareholders, and this is the retained loss that has been made so far. So in effect, they've put in 2.6 billion and they've lost 1.3. So effectively, there's still a little bit of equity in there, but they're eating into their equity. And you notice that that's a pretty consistent picture, or a pretty consistent story. So this is a company that is making a loss. If we look at up at the top, we can see the amount of cash they've got. They start with 250. You can see the cash is going up, and now they've got 1 billion of cash. But that 1 billion of cash is effectively coming through the shareholders' investment because they're continuing to make losses. So at some point, you kind of think, at what point do the shareholders go, we've put enough money in this, we're not going to put any more money in, you keep losing it, we're walking away.
Yeah.
And the story from the company is, yes, but we're just about to make a profit, and once we make a profit, then we'll start to return the money, and then we've hit terminal velocity, and the sky is the limit, so to speak. So what's interesting here is looking at the cash flow statement. And here is the cash flow statement. So we can see up at the top, we can see that they're actually generating a loss every single year. But this is the interesting line. They've been making a loss in terms of cash, but now they're cash positive. So that is the story, that we're now generating cash. We're about to break even and start making money on a P&L account. We're generating cash. We no longer need to carry on fundraising. We're starting to kind of clear the Earth's atmosphere, so to speak, if you use my space shuttle analogy. Let's go and have a look at the cash flow for Deliveroo. So here is the cash flow to Deliveroo. There's the loss they make during the year, and there is the net cash used in operating activities. 2019, they grow the business, the loss gets bigger, but the cash loss gets less. So they're not cash positive yet, which is why they need to be borrowing this money. They need to be raising cash to make sure they've got enough in the bank to survive. So if we look up here in the balance sheet, the real question is, looking at this cash balance here, have they got enough to survive on as they continue their expansion, or are they going to have to keep coming back to the shareholders? And at what point do the shareholders go, you know what, I've had enough, I've put enough money into this company? Okay, so they'll have projections that say that, we're good, it's going to work, we're gonna break even, we're gonna then carry on, we're gonna dominate the market, Uber Eats is going to go out of business, and this is our success story. Buy into it.
Yeah, interesting. And those watching this should stick around, because we actually found something interesting about the owners of the business. So that will tell a story about how much patience they'll have as well.
Absolutely. So let's look at other parts of the accounts and see what they're actually telling us. So as I mentioned, I've been looking at these accounts and I've dug around, and this I thought was a really interesting one. This is a note to the accounts in Deliveroo's or obviously Roo Foods accounts, and it talks about the principal risks and uncertainties. And I think this encapsulates exactly the challenges. So the first challenge they've got is new competitors. Moeed, what stops you and me setting up Ted and Moeed's delivery company and competing against Deliveroo?
On a small scale, nothing.
Absolutely.
Nothing really.
So I can go around to my local fish and chip shop. I can say, look, let me deliver for you. I can put a leaflet through a whole bunch of houses and say, I'll deliver fish and chips for 50p, for example,
Yeah.
and we can negotiate. So actually the barriers to entry are very, very low on this.
Low.
They're talking about a volume game. But then to a certain extent, the barriers to entry to Amazon are pretty low as well. And there's lots of people who make a living on eBay and they buy stuff and they sell it on eBay, for example. Regulation is another big challenge for these guys. The whole gig economy. Are they employees? Are they employed? Do I have to start looking after them, giving them sickness pay and national insurance and holiday and all the benefits? And Deliveroo just wants to contract people, just to say, I'm only going to use you when I need you. And the government legislation sitting on top. So that's a real mess of a kind of murky, regulation. It's a pretty horrible, messy situation to be in.
Yeah.
Because if I employ somebody to kind of, to do it on a Friday night for, a couple of hours a month, I don't want to have to start calculating how much holiday they're entitled to, etc.
Yeah.
The group's dependent on technology. We kind of expect that, it's all about the app and this is where we're living these days. And it does say the group is currently loss making. There is a risk that execution of its strategy could be inhibited by insufficient cash being available. So that's where we get down to going concern. Now it's been signed off as a going concern, and they've convinced the auditors that they're a going concern. They've got enough cash at the moment, but they're saying we are burning cash and we need to turn that around. And those four risks together say that, this is not a solid, safe bet. This is not, you're absolutely guaranteed. This is closer to the kind of Las Vegas, the roulette wheel, than it is to, sticking your money in the bank account, so to speak. So you want to make sure that if you're going to take these risks, and maybe it does work, but if you're going to take these risks, you want to make sure that you are compensated for those risks. Either return or the potential upside is going to reward you for that. So here they have, this is the statement of going concern, and they talk about how they're making a loss and that, they're kind of, they need to sort of generate more. You'll notice up here, they talk about Series G fundraising. So the Series G fundraising. So this is really a sort of reflection of a startup company. It's a couple of blokes in mum's attic. They kind of, they're working it. They need to make some, need a bit of investment. They go out and they do some, they get some investors in. That's what you would call Series A. And then Series B is when they have to go back in Series C. So it's really just a way of measuring how often people are going back to the market and raising money. So you can start to see that, they've actually raised another 575 million since these accounts. Okay. Sorry, during these accounts. So that's reflected in 2019. But what I found really interesting about this was this line here, that
Yes.
Amazon are a big investor. So I've kind of likened these guys to Amazon, and we've talked about the network effect a lot, Moeed. So Facebook's network effect is that everybody's on Facebook because everybody's on Facebook because everyone's on Facebook. It's really difficult to get in there. Coca-Cola's kind of network effect is the brand. Everyone drinks Coca-Cola because they buy into the brand. They don't want that kind of that cheap cola. We've talked about Amazon, for example, or Apple, for example. Apple's network effect is what they call the ecosystem. It's the fact that cloud, it's the fact all my systems talk to each other, and that I can get my documents on my phone because they're on the cloud with my laptop, and and so they create this lovely ecosystem that we kind of we want to be part of it. It just makes our lives easier. Amazon's network effect is we buy things on Amazon because it's just easier. It's, I don't even think about it. It's like, oh, I need a new plug, a new adapter. I just type it into Amazon and it arrives the next day because I'm on Amazon Prime, and it's easier. It's not necessarily cheaper on Amazon, as sometimes we find out, but it's a kind of a default stop. And Amazon have got there because they're on the scale. Now, which of those, Facebook, Apple, and Amazon, do you think Deliveroo is trying to replicate?
Well, there's an element of an ecosystem here because a big part of Deliveroo's business, I think, will come from restaurants where they try to create exclusivity with them, right? So the more types of restaurants you have within a demographic of your customers, the better market share you can command. To me, it feels more like Amazon, and partly because Amazon have invested in them. So clearly Amazon sees some sort of extension to their business. There's an element of their ecosystem that they can help Deliveroo with, and thereby increase their value and therefore the value of Amazon's investment. So it seems more like Amazon, but there is an ecosystem element to it that's, I wouldn't say similar to Apple, but there is an ecosystem.
You're absolutely right that it's that the restaurants are going to be on there for the clients, for the customers to be there, and the customers want the restaurants. There's stories of these types of companies actually just making it up and just putting restaurants who haven't actually signed up to it, but they just put them on there just to say that we can do this. Again, creating that. McDonald's, I think, is a very big. That's the big brand name. If you can get them on, then you kind of that's a big market share, etc., etc. So to a certain extent, you're right. Although to what extent will the competition and the kind of the competition markets authority allow exclusivity? Perhaps we could go in and say, look, it's anti-competitive to make people sign exclusive. So there's that kind of the regulation is going to be in. There's going to be a bit of an issue. So I think, but it really is, it's an Amazon, and you suddenly think the power of this. If I'm running Deliveroo and I can say to Amazon, oh, just give everybody who's an Amazon Prime a 10% discount or a voucher or whatever it is, bang, so you can get out to market. And obviously Amazon as an equity investor is going to have a vested interest in that. Now, that's not the case when we look at Deliveroo, for example. So when we look at who owns Deliveroo, when we talk about DoorDash, so we look at who owns DoorDash, we've got the people like Tony Zhu, who's the CEO, owns 5.2. So that you've got the kind of the starters are going to own some of it, but the big investors are the VCs, the venture capital companies, and they may have a lot of power behind them, financial power. And I'm thinking that Amazon has certainly got a lot of financial power, so Amazon can just say don't bet against me because my pockets are bigger than yours. But they don't have these are kind of standoff investors. They're not going to be active like Amazon. Amazon is going to bring more than just investment to the party. So if I'm looking at DoorDash versus Deliveroo and I'm thinking, who am I going to invest in, who's more likely to win, and it's a very competitive market, I'm slightly erring towards Deliveroo because they just got this big backer sitting behind them who can actually just go out and kill the competition by using, the Amazon leverage. And you'll notice that it was actually the markets authority actually checked to see is this going to be anti-competitive, does this give them an unfair advantage, for example. But they've let Amazon actually make that investment. So you talk about the valuation, Moeed, and I think you were talking about Deliveroo being worth 7 billion.
Yes. which was surprising because the market, according to statistics, and this is 2019, so obviously the market will have changed in 2020, particularly with the pandemic. But in 2019, the total valuation of the market, right, was 8.5 billion pounds. And Deliveroo are saying that they're worth 7 billion, even though, and this is an important point, they are not the biggest share, right? The capture. The company that has the biggest market share in the UK is Just Eat. And then it's Deliveroo. So the valuation seems surprising to me, particularly given the fact that they're number two and that the total market valuation was only 8.5 billion. It's probably going to be about 2.3, sorry, it's probably going to be about 9.3, maybe slightly more for 2020, but that's just an estimation given on the numbers that are unaudited. So yeah, I'm really surprised and keen to hear your thoughts on this.
Well, I think it's interesting if they're, you know, that they're accelerating towards flotation. And I think the reason that a lot of these companies are doing that is that for them, 2020 has been a fantastic year. Why? Because the world's been in lockdown. So, you know, this is where they've actually thrived. They've really managed, you know, I mean, you know, the streets are empty apart from Deliveroo and Just Eat cyclists buzzing around, you know, delivering pizzas and you know, the curries, for example. So I would be, you know, I would struggle to put a 7 billion valuation on it. I think that there's a lot of headwinds which were articulated by Roo Foods in their accounts. The fact that, you know, I think that, you know, come 2021, once we get out of this whole lockdown, and it has to happen, we've got vaccinations are here, you know, there's only so much longer that I think that the public are going to accept the lockdowns. They're just going to say no, we refuse. So people are going to get back out there, and, you know, there's still going to be the service, there's still going to be takeaways, there's still going to be the opportunity for, you know, to deliver. My local pizza place, they have their own delivery people. They have Deliveroo delivery people. I can walk up there, I can collect it myself. Guess what? I'm going to do the one which is cheapest.
Yeah.
And there's always going to be that degree of competition. I don't think they're going to be able to do exclusivity. I think that they've got a lot of headwinds in terms of, you know, the regulation around the gig workers and making sure that, you know, they can cost it correctly. It's you know, it's a very competitive marketplace, and I can't see it not being a competitive marketplace. And I just feel that there's a sense that, you know, what's the kind of, you know, what's the end game? Is it going to be world domination like Amazon, for example? Are we really going to only have one company with bicyclists, you know, and are they looking for driverless cars? Is that how we, you know, is it going to be drone delivery? Maybe that's the kind of you know, the end game. Maybe we're going to have our pizzas flown to us by drones without actually, you know, any gig workers at all. It all just sounds quite high risk. I'm not saying that you can't make money, and I think an interesting example here will be a little bit like the railroads, for example. So, you know, we head west in America, lots of companies laying railroads. Most of those companies went bust. But the companies that survived bought the companies that went bust, and the infrastructure was laid and they thrived. Yeah. So, you know, the business model is here to stay. Is Deliveroo going to win, or Uber Eats, or DoorDash, or any one of a number of different companies? Who knows? Okay. But one of the companies is going to win, and it may do an Amazon, and it may win big. So I kind of, if I'm going to put my money anywhere, if I was faced between DoorDash and Deliveroo, I'd be tempted to put it in Deliveroo. But actually, I kind of feel for the price we're paying and the risk we're taking, I'm not saying you can't make money, but I'd be better off elsewhere. It's a bit like going to Las Vegas and putting your money on the number 17 on the roulette wheel. You can make a lot of money, but it's high risk. So you need to make sure that you're being compensated for the risk that you're taking.
Yeah, a couple of things to add there, because yeah, spot on what you're saying. And that's certainly the things that I've read in terms of the analysis are leaning towards what you described. my view is that it feels like this valuation is based upon not winner takes all, but winner takes most. And I have, Amazon being involved in this game means that the elements of the business seem to be aligned. And what I mean by that are a few things. Number one, reliability, right? Reliability of delivery, speed of delivery. When you say those two things, people think about Amazon straight away, right? It's reliable, it's fast. If there's a problem, you can return it very quickly. And I've experienced problems with Deliveroo, and their customer service has, in my experience, been great. They will send over a new order free of charge when there's a problem, and they've done that twice for me. The next part of that is going to be over the logistics. It's going to be the range of choice, right? And it seems that Deliveroo are really, really pushing, because when they started out, and I started using them back in 2016, so that's 4 years ago, Deliveroo are known for having partnerships with the more healthier styles of restaurants, whereas Just Eat was the kind of, boozy night out takeaway, and you didn't have to go and find any food and bring it back when you're drunk. You can just order it to your house. Whereas Deliveroo is more about healthy. Now it's starting to expand into a lot wider. So I think range of choice plus reliability and speed, and then price, right? Who's going to offer it at the cheapest price? And I don't know, for me, that all of that just screams Amazon to me. So I would agree with you that my bet would probably be on Deliveroo, but it seems like they're betting on a new trend, right? So and they're also betting on a winner takes all, or winner takes most. But is it going to be that profitable as a business? I don't know if it's going to be a profitable business, right? So is it going to be a high margin business versus the traditional restaurant and food industry where it's typically low margin? And at the end of the day, after the pandemic, look, people still enjoy going out to eat. So how much of that's going to affect the amount of revenue that Deliveroo are going to have on a yearly basis, I don't know, but it's certainly going to eat away at that.
Absolutely. As I said, lots and lots of headwinds there.
Yeah, agreed. So this was a really interesting one, Ted. Really interesting. I'm glad that we looked at this because it's becoming a really big thing. And, like I said, 7 billion, but those who are watching this, do your homework, right? We've helped you look at the right things, so you can start looking at those finances and making your own decision. But yes, Ted, thank you very much. This was really, really interesting.